Yeah, the RBI actually has been quite hawkish about inflation, in particular food inflation. Our call has been that the RBI would ease rates in Q4 of the calendar year, most likely in the December 2024 meeting, after the Fed undertakes an expected easing cycle from September. Uh, this growth number will come as a surprise to what the RBI's estimate has been. We think growth will slow down slightly more as you head into Q4. We are heading towards sub 6.5% in the second half of the year, and therefore we think that with food inflation topping out, if the weather conditions stay okay for the month of September, especially, you've had good rains till now. The sowing of the summer crop has been good, and therefore we think the balance of risk on food inflation is towards the lower side, absent any weather-related disruptions that you see in September. Then the RBI should be in a position to sort of tone down the hawkish guidance in the October meeting. But we think that they start easing from the December policy onwards. Still, we think it's a shallow easing cycle in India. You can never be sure about food inflation, and unless growth really materially slows down, we think the RBI will be only easing 50 basis points, 25 each in December and in the February meeting. But you're going to have liquidity conditions benign, which is going to aid the transmission of rate cuts in India.
And what about the currency? We've seen the rupee log a second consecutive monthly decline. Where is that going?
Yeah, so on the rupee, our view has been that it's been very low volatility, high carry, if you look at the overall emerging market complex. And our view in the overall EM complex for the rupee has been that whenever you have a strong spell of the dollar, the rupee tends to outperform the rest of the EM pack, particularly Asia. Whenever you have a weaker dollar, which is what you're getting to see now with the expected Fed rate easing coming through, you will have an underperformance of the rupee, which means that on a vol basis, on a volatility basis, it's quite low, and that's what you're going to see going forward. Our view still remains that the RBI will be accumulating reserves whenever flows come in. Our current account deficit forecast is in the about 1.3% of GDP. The risks are it'll be slightly lower. And when you're having these kind of flows come in, both from the bond inclusion as well as from an expected weaker dollar and therefore, a better flow story for EMs, we think that the RBI will be continuing to accumulate reserves. It'll also, by the way, play into the monetary policy easing cycle, which we are forecasting by the end of the year, because it wants to keep liquidity conditions benign so it can acquire reserves in spot and keep injecting liquidity.